I want to discuss how we bottom in a major bear market. So I always discuss the fact that you want to have a prior rally of at least 30%. But after a very big bear market, let's bring up the NASDAQ here. Let's go to the NASDAQ. Let's go back. Let's rewind. 2009. After a big drop like this, it's hard to get very big uptrends, or so you would think. There's always going to be constructive price action on the right companies. But let's go back again, 2003. Oh, brutal drop. But there's always going to be constructive action on buyable companies. So last week, I think it was last week, or it was the week before, at least, we looked at eBay as an example. And the beauty is you want to go back in time and study the way I approach is whenever I feel I'm in a certain period of time. So, at the beginning of the year, I was really studying the 1970s, everything I could about inflationary periods in other countries at different points in time. And when you think you're in a certain economic backdrop, you want to go back in time and study stocks during that period to see what to expect and how to react and how things should develop. So now's a great time to go back and study that 2008, 2009 situation with that crash. And it really just how the stocks eventually bottomed. I mean, we haven't gotten this kind of a free fall yet. Not impossible that we do. It could be a much slower grind, but how do we get to that bottom? So there's a number of stocks we could look at. First, let's take a look at BKNG, which is now Priceline.com. So this looks like a really big V bottom here. And at first glance, there's really not a lot you can do with this. But first of all, let's look at the aftermath of what happened with this stock. See, it's off the charts. Let me bring up a weekly chart here where the scaling is a little more controllable. Let's go back to 2008. So again, here's our big drop down to 2008. And from those lows of, call it $50, we have a 10-fold move in just a couple of years' time. Now, this is why you need to always be prepared, because coming out of that bear market drop, you either bought it around this time and you established a big position on the way up and you made a life-changing advance, or you went away, you stopped watching, you finally came back and said, oh, the market's no longer in a bear market. But now, instead of making 10 times your money and you buy it on this base up here, which is 121, you make 2 or 3 times your money. And that's a significant difference, especially if you keep pyramiding along the way. But, at first glance, again, it doesn't look there's a lot you can do. It's kind of a V bottom, but let's take a look much closer at that period of time to see how we could have approached the stock. Let me get rid of this. There we go. So this was that crash that we had here in 2008. Now, it's interesting that the market actually made lower lows in March of 08, but Priceline never made lower lows after this low. And also another thing I want to point out, I know a lot of people are going to start talking about interest rates, that interest rates may start falling soon. And they'll say, oh, interest rates are falling, so that's it, the bear market's over. But although the stock market is a leading indicator for the general economy, interest rates are a leading indicator for the stock market. So when you do see interest rates starting to fall, it's going to take time for that to filter and then after undo all the damage that happened. Because once we get this negative feedback loop, like Ray Dalio spoke about, where dropping equity prices and after, reduce people's buying power, it impairs financial institutions, which makes lending more difficult. So even when rates start to decline, it takes time for that rate decline to undo all the internal damage that took place because of the decline. But once we had this big waterfall decline, and this is November 08, we had this nice first rally. So we didn't have to buy anywhere on the low. I know it was very nice to kind of buy right down here, but there were many other points. This looked like a buyable low. 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 And that's why, again, I'm never going to bring up one of last year's leaders and say, hey, look, this really has got to go now. That's not the way you safely buy companies. It's just the odds are against you. One will work, but many will kill you along the way. So it's just really not worth it. But do you have that prior uptrend? Well, once we hit bottom and we start to rally, you see very quickly, because the stocks are so depressed, it's very easy to get a 50% advance off the lows. This quick little bump up here is a 54% advance, which is significant. But in these market drops, the volatility is so high. Now, this is below the 200-day moving average. Will I ever buy anything below the 200-day moving average? Well, if you're in a really very large crash type scenario, That's one of the very few times where I'll potentially break that rule. Now, why would I break that rule? One is the stock needs to show relative strength. You need to see some kind of Fed action that is trying to reverse the course of events. So you have that impulse from the Federal Reserve. You want to see some kind of improvement in the market. Now, take a look here at the net lows. As bad as we were in the great financial crisis, very soon you got back to net highs, just about the time we got back above the 50-day moving average. So as a backdrop, I know I don't talk about this in the course because if you kind of include every possible scenario and output, it'll become so overwhelming and confusing that it'll kind of defeat the purpose. So that's why, I can kind of talk about these in real time here as they come up. But as a backdrop, if I'm below the 200, I need to at least be above the 50-day moving average. And that would have really kept you safe on this entire drop. Here you're below the 200 and you weren't above either of the two until back over here. Now, ideally, I always will focus on stocks above the 200, except if we're in a crash scenario and the Federal Reserve has become accommodative. We have this AB relative strength in the stock, and you start to see a change in the market dynamics. I forget the exact day of the fall today in the market, but you can see we had this nice move higher here, and then the stock started to base. And this is where you could have began looking for buyable opportunities. So if we take a look at BKNG on the weekly chart, and we go back in time, where are we here? Okay, let me fast forward just a little bit. Okay. So we had our first kind of cup base pattern right here at the, let me bring that in the screen properly, about the $76, $77 mark. That was $76.46. It was 1 week earlier. Usually we want this to be 7 weeks. But you have to look at the face of the kind of immense strength that the stock is showing. It's just incredible, incredible strength. And that would have given you this ability to get into this major, major advance. In fact, even if you did miss this cup pattern and you waited for above the 200-day, you were still in the 80s area. And there was this major, major significant advance. So when you're in this extreme scenario, you have to start balancing factors. And, also when you made this kind of cupping pattern, your Caruso adaptive relative strength came in. So that was another thing in your favor. You actually had a period here where you saw net highs in the market. The AB relative strength was screaming off the charts. The company also, if you take a look at earnings down here, were surprising to the upside over and over and over. So this was really a compressed spring. By that, I mean, think of the stock as a spring wanting to go up, but there's this giant weight of like an elephant market sitting on top of it. The second that elephant comes off, the spring is going to release and move higher. And that's how you get the underpinnings of a 1000% advance that completely changes your life. And the best opportunity comes out of these bear market scenarios. And also if you look at the Caruso adaptive relative strength backgrounds, virtually every single significant uptrend came with a backdrop of relative strength. So beginning with stocks that show good earnings, like we see right down here, then after that have minimal technical requirements of at least a prior uptrend or to be above the right averages, and then having adaptive relative strength show up, you've just gone from 10,000 stocks where maybe something can be good for you or the bottom can fall out to suddenly a stock where there's immense upside potential and very downside risk. You get out if you're wrong, but out of the 10,000 stocks, you've narrowed yourself down to 10 or 20 different stocks. And I think that's just a phenomenal to have that kind of probability. Even if it's not today, it's 3 months or 9 months from now. I think to have that kind of potential, it's worth the wait. So that was BKNG, but a lot of people know the Priceline story. It's kind of a big name, but if we go to F5 Networks, they were in the cloud space back then. Let's take a look at that, a little bit of a different pattern. So we can see here, so this is FFIV. So whereas this was kind of weak early in the bear market, then it kind of just already tried to start to solidify. So again, that AB relative strength here came out differently, whereas the market really cratered. This stock, if we go back even to that exact same point, just wasn't falling anymore. So again, it was really screaming at you. And also, just big picture, look where the bull market really came in. We're going to look at how we could have started to look down here for entries, but when the market became healthy, that's when you got, again, this staggering advance. And we went from the point we're back above the 50 at $22 to $146 in 2 years, another staggering, like 7-fold advance. But as the market declined here into March of 2009, you start to see this adaptive relative strength really kick in right here. Then we start to switch back and forth. Let me just adapt that scale because there were so many net lows. You start to go kind of back and forth between net highs and net lows. And so you could really see the market becoming healthy under the surface. And if you draw a beautiful 3-touch trend line as we get back above our 50-day moving average, that was really the clincher that got this thing running away with the ball. And again, what's the common theme? They surprise with earnings. They surprise with earnings. They surprise with earnings. They surprise with earnings and sales. They surprise with earnings. They surprise with earnings. They surprise. So again, it's earnings that drive the big moves, but you're going to be able to see that on the chart when with the relative strength background. Again, of the 10,000 stocks you could choose from, which stock in 2009 was showing adaptive relative strength, AB relative strength, and beating on earnings? And when did you actually buy the stock? When you had a very nice 3-touch trend line. You were below your 200, but at least you were above your 50-day. If you'd want to be patient enough for that, you could have waited for additional proper basing structures here or above the 200-day moving average. But when you finally get that follow through day near the low, when you finally start to get some net highs come in, you have to keep in mind the market fell 40%. You're not going to get perfect 20%, deep base structures. So you're going to want to put together all the elements of quality to find which stock can I buy, and the earnings are going to be there and the relative strength is going to be there. Those are going to be some almost certain things that you have to see. So I have some more I want to go over. I'll save that for another lesson, but take a look at FFIV and then go, take a look at how you would have played this entire advance. It's a great study stock because a lot of people don't know it that well. It's not a Google or a BKNG. Also, I love how the adaptive relative strength kept you in for the majority of the move, except there was this gap down. So that's always a gap down risk of earnings, but kept you out of all this junk. And then after kind of like re-engaged here as we had this other uptrend. But again, you're in an accumulation phase of a stock when you can see how the volatility of the movement diminishes. And that's such a powerful thing when you can train your eye to see that. Look, as soon as the stock tops, look at how the volatility is wild and crazy. That's why you want those constructive bases. You want that relative strength, and you want that volatility to diminish on the way up. So there's a really good example of what to look for, including the market backdrop. And thanks to TradingView, you have all these great tools that you can go back and study, and it's just so awesome to have.